If you're currently looking for the opportunity for your next investment while the unsuccessful investor sits on their hands, then investing in our Brighton Property Development Project may be the solution you're looking for. We've secured a great development site on 17 Hall Street in Brighton, which is a really well-positioned block of 750 square meters and only a few minutes away from the famous Brighton Beach. The fact that it's a corner block allows us to pursue 3 4-bedroom luxury homes with very high-end specs, underground private and secure parking of up to 3 cars per residence, private pools and rooftop terraces with spas and pools in order to enjoy the spectacular views in style. This is a wholesale investment opportunity with a limited capacity, but for the few investors that make it in, we're offering either a target return of 35% over a term of 2 years, all paid at the end, or a 1% paid per month over a term of 2 years. Okay, at this moment I can literally hear you think, what's the catch and what are the risks? And given the current COVID-19 environment, I don't blame you for thinking that. So let's spend some time to go through some of the main risks and more importantly, what we are doing to mitigate them. So the main risks involved are planning, construction, sales and timing. And let's start with planning. This is an integral part of a successful project. This phase takes us from an idea we have in our head to council providing us with a development approval, or DA. In order to ensure a project is lucrative, one must play the game on the boundary of what is allowed. And because we don't pretend to know it all, we surround ourselves with local experts, expert architects and town planners who have experience with the approval authority of the council, in this case Bayside City Council, and have a proven track record of getting it over the line with them. Then there's the construction risk. What happens when the builder goes bankrupt? It's an extreme example, and even though it's unlikely, it can happen. It happened once to us, and thanks to always having a plan B ready, we responded well and within days had signed contracts with the replacement builder. The timing was a little off thanks to this, but we still paid out 42.5% return. Also, as a developer, we are insured for these things. The builder that completed the development for us did that so marvelously that they ended up doing another 5 projects for us. Furthermore, we always engaged in fixed price contracts and often obtained personal guarantees from the builders. Thirdly, the sales risk. Our projects often rely on satisfactory selling of the end product, and for this reason we approach each feasibility test very conservatively. And if very conservative sale figures can't make the project work, we do not take it on. We approach each project with its own strategy. Some projects can be sold off the plan, some projects will deliver much bigger returns when sold upon completion. We created quite a bit of good content on our website around how we approach the sales of our projects. And lastly, the timing risk. In property development, it is here impossible to guarantee a certain time frame. There are simply too many variables at play that often a conservative estimate is the way to go. What we can do, however, is imposing a delay penalty clause upon ourselves, so that if we go over time, our investors are additionally compensated out of our pocket, something we definitely want to avoid. Okay, so these are the main risks associated with property development. In our information memorandum, we've highlighted some of other risk mitigations. I trust this was helpful in understanding how investing in property development works with us. Big gains are there to be had. However, it's not for everyone, and it's okay. Reach out to us when you wish to talk further or be granted access to the investment information and the legals. We're here to help.